Hello, everyone. This is Tony Welch, Chief Investment Officer at Signature FD, with this week's Cutting Through the Noise. So, this week's message is that the economy and markets continue to show resilience, even as the headlines remain noisy. But underneath the surface, leadership is becoming increasingly narrow, particularly in AI related areas, and that's creating a nuanced backdrop. So, one important point this year is that returns have actually been broader than many investors realize. Yes, semiconductors and AI infrastructure stocks continue to dominate the headlines, but we've also seen improving strength from small caps, international markets, and cyclical areas. That's important because healthier bull markets tend to broaden over time rather than rely indefinitely on a handful of stocks. It's also one reason we added to small cap positions and international exposure earlier this year. So one of the behavioral challenges for investors is that new highs often feel dangerous emotionally, but historically, new highs are more commonly associated with strong momentum and healthy economic conditions than with imminent market peaks. Now, that doesn't mean that markets move straight up from here. In fact, we're seeing some signs of overheating in areas like semiconductors, as we mentioned before. But the broader lesson is that strength alone is not usually a reason to become defensive. The bigger question is whether participation broadens out from here, and that's what we're watching closely. So, from a macro perspective, the labor market was the most important story last week. Payroll growth came in solid again. Unemployment remains stable around 4.3%, and weekly jobless claims are still relatively subdued. Wage growth also remains below 4%, which helps reduce the risk of a wage price inflation spiral. What's interesting is that despite the rise in oil prices tied to the Middle East conflict, we're still not seeing the kind of second round inflation effects that typically force the Fed into aggressive tightening. At the same time, there are offsets helping cushion the economy, including AI related investment, fiscal support, and still solid household balance sheets. The result is an economy that continues to expand, even if that growth is uneven beneath the surface. One of the more important observations this week came from our research partners at Strategas. A lot of investors understandably compare today's market environment to prior bubbles, particularly the late 1990s. But when you actually look underneath the surface, the story is quite different. Forward earnings estimates for the S&P 500 are up roughly 13% this year, while the market multiple or the price to earnings ratio has actually contracted modestly. So in other words, the market has gone higher because earnings expectations have improved, not because investors are simply paying higher and higher prices for the same earning stream. That doesn't mean valuations are cheap. Some areas absolutely look extended, but the broader index fundamentals are more grounded in earnings growth than the headlines might suggest. Now, turning to the market trend, the backdrop remains constructive overall, but leadership has become increasingly narrow. Semiconductors and AI infrastructure stocks are now trading at historically extreme levels relative to long term trend measures. So the semiconductor index is more than 50% above its 200-day moving average. And that's something that's only previously been seen around the late 1990s tech boom. Now, at the same time, only about half of S&P 500 stocks are currently in confirmed uptrends. So, while the headline indices continue to look strong, and that's a good sign, participation underneath the surface is much more mixed. And importantly, narrow leadership alone does not end bull markets, but historically, sustainable advances eventually require broadening participation beyond the initial leadership group. And that's why we're watching for a leadership transition from AI enablers being rewarded towards those broader adoption beneficiaries over time. So, to wrap things up, we continue to see a market and economy that are more resilient than many expected earlier this year. Now, that said, the environment beneath the surface is becoming more nuanced. Leadership is narrow, some AI related areas are clearly stretched, and geopolitical risks remain elevated. At the same time, fundamentals remain supportive. Labor markets are stable, and we're beginning to see signs of improving participation outside the largest tech names. For us, that continues to support a balanced and diversified approach rather than chasing whichever area of the market has become hottest most recently. And that's what we have for you this week. And as always, I want to thank you for listening and wish you a great week ahead.